What's up, guys? Welcome back to the channel. Today we're going over what the best options trading strategy is for small accounts. Also, make sure you guys stick around to the end of the video because I'll be buying a credit spread live and I'll be selling one to show you exactly how it works. So if you're interested in that, make sure you stick around to the end. So what is the best trading strategy when you have a small account and you're wanting to trade options? Well, in my opinion, you would want to trade credit spreads. Now, before we go over exactly what a credit spread is and how it can help you when you have a small account, first you need to understand what selling a call and selling a put does, because that's half of the equation. So we'll start out with selling puts. So currently the price of Bank of America is at $24.45. If you were to sell a put on Bank of America, you're betting that the price goes up. So if you have a hunch that Bank of America is going to spike for some reason, maybe it's earnings season or something like that, you would sell a put. But with selling a put, you need enough money in your account as collateral to buy 100 shares. So for example, the price is currently at $24.45. If you were to sell this put here at a $23 strike price, you're selling this premium to the person on the other end who's buying the premium. I suppose I should have this set to sell, but either way the prices remain the same because one person's buying and one person's selling. When you're selling a premium, you're the one who collects this premium. So if you sold this premium, you collect this and you keep $6 no matter what happens. And you're hoping that the price goes up, because if the price goes up, nothing happens and you just collect the premium. If the price drops below the strike price, you have to buy 100 shares at this strike price. So when you're selling, you want the opposite to happen of what would normally happen with a call or a put. So when you're selling a put, you want the price to go up, where if you were buying a put, you would want the price to go down. So now let's check out calls. If you were selling a call, say you sold this $26 strike at $6 again, you collect this $6 and you're hoping the price stays the same or goes down, as long as it doesn't surpass this $26. If it surpassed $26, you're forced to sell 100 shares. So when you're selling a call, you need 100 shares if you were just selling calls. When you're selling a put, there's a potential that you have to buy 100 shares. So when you're selling a put, you just need the money in your account to purchase the 100 shares as collateral. But when you're selling a call, you need 100 shares of a stock. So this maybe seems a little confusing right now, but we'll get more in depth here as we go and as I explain credit spreads. So let's get into those now. So again, we'll start with put credit spreads. So with the credit spread, you're selling the more expensive premium and then you're buying the cheaper premium. So here, this one is $24 and you're selling one right below it for $12. You keep the difference between these two premiums because you sold this one and then you have to buy this one. So you would keep the difference between these, which would be $12, and that would go right into your account. But then as protection, you have to put up a collateral. And the collateral is the difference between the strike prices times 100. So in this case, this one's $23.50 and this one's $24. So you would have to put up $50 as collateral. And what you want to happen is you want the stock price to go up, because you have two premiums here, but you have this $24 premium, which outweighs the premium that you bought for $12. And because if you were just selling this premium and you weren't buying the one below it, you would want the price to go up. So you still want the price to go up even though you're buying this one. Essentially what happens is if the price goes up, you just keep the premium, and then you get your $50 collateral back when this expires. But if the price, which is at $24 right now, if it dropped below this strike price, say it dropped down to $23, well, you would lose the difference between the strike price, which is $50, minus your premium that you collect, because you always keep the premium no matter what. So you would take $50 minus your $12 premium that you collected, which is the difference between these two. So you would only be risking $38. So the most you could lose in this situation is $38, and the most you would gain is $12. It doesn't seem like a great ratio, but when you take into account other factors that I'll explain later, it definitely seems like a pretty good option for small accounts. Because if the price just remained stagnant and didn't move, or it went up, you collect that $12 and then you get your collateral back. So you just made $12 for the price staying where it's at or going up. So now you're maybe wondering, how are you protected and how are you only risking $38? Well, like I explained earlier, you're selling this premium at $24. So if the price dropped below $24, you'd be forced to buy 100 shares at $24. So you'd be paying $2,400, but you buy this premium below to protect you. So if the price dropped below this $23.50 strike price, you have the right to sell 100 shares at this price. So if the price dropped from 24 down to 23, you had to buy 100 shares at $24, but then you get to sell them for $23.50. And this all happens automatically. Like, you don't get to hold these stocks because it's a credit spread. It just happens automatically if the price dropped below $23.50. It would execute and you would buy these shares and then you would sell them at this price, and that would all happen automatically. And then you would be out the $50, which is the difference between these two, but then you still collect your premium, so you're only out $38. But the upside to a credit spread is that you always collect the premium, no matter what happens. So if the price went up and stayed up and didn't drop below, you collect that premium, which is between these two, and then that's the end of it. You just made $12 pretty much for doing nothing. And then if the price dropped below, you would lose $38. Another common question people ask is whether you can secure profits before expiration, and you certainly can. If you were to take this put credit spread that you bought here, so you paid $12 for this premium and you sold this one, so you have a $12 premium that you collect between them, and you keep that no matter what happens. But if the price were to jump, say it jumped from 24 and it went up to 26, so that's essentially 3 strike prices it went up. So if you were to move this $24 down 3 strike prices, which is essentially what would happen because the stock price went up 3, if you moved it down 3, it would now be worth about $3. And then this strike that you bought as protection would now be worth $2. So you're buying it back for 3, but you got paid 24. So you profit $21 between these two. But then you bought this premium as protection, which you have to now sell for $2. So you're losing $10 between these two. But you gained $21 between these. So you take 21 and you subtract the 10 that you lost here. So you made $11 profit. And if you were to hold till expiration, you would have made $12 if the price stayed above this strike price here. So you can definitely pull out and secure profits if you want to. It's just that if you were to hold all the way till expiration, you're getting the full amount. And this is kind of exaggerated too. Normally, there's not this big of a jump between strike prices that are this close because it's kind of taking into account that this stock price isn't going to move a lot. So this isn't what would typically happen. What would maybe happen more often is that the price goes up 1 strike price, and so maybe this 24 drops down a level, and now it's worth $12. Even though you bought this one for 12, this 12 might only be worth 6 now. So because you originally sold this for 24, you have to buy it back for 12. And because you bought this one for 12, you have to sell it for 6. So your profit here would be only $6, where if you held till expiration, it would be $12. That's more realistically what would happen. But I think that kind of explains the idea of how you can secure profits at any point before expiration if you're in the profit margin. So if you had a credit spread for a put, like in this example, where you sell this premium and you buy this premium, you can determine your profit at any point in time. You just take the difference between the original spread, so in this case it's $12, and then the current spread, when the stock price moves in your preferred direction. So when you have a put credit spread, you want the price to go up. So if the price went up and then your credit spread dropped, say it dropped down, like before, so this 24 dropped down and now it became $3, and then this 12 became 2, you just take the difference between the original, which is $12, and then you subtract the difference between the new contracts. So in this case, you would take 12 minus 1, and then your profit would be $11. And that's the profit that you can take out at any time. So pretty much when you have a credit spread, you want the price to move the opposite of what the normal option is. So when you have a put credit spread, you want the price to go up, and then you're making money. Because as the price goes up, the spread between them gets tighter. So like here, it's only $1 difference, and then you're making that difference, like I explained. But say you had a credit spread with calls. Normally with a call, you want the price to go up. So when you have a credit spread, you want the price to go down. So it's the same thing as puts, but it's just kind of reversed. So if you wanted to buy a credit spread for calls, you're betting that the stock price goes down. So you would sell this more expensive premium, and then you would buy this one above it. Or you could do that at any point. You could sell this one and buy this one. Generally, you want to stay out of the money, which for calls is prices above the current price, and for puts, it's prices below. But you want to stay out of the money because unless you think the stock is really going to spike, you're going to lose out on your collateral minus your premium. So with a call credit spread, you want the price to go down. But if you bought one in the money, say you bought a credit spread here and you sold this 190 and you bought this 142. Well, if the price doesn't drop below this, below 22.5, you're going to lose your collateral minus your premium. So $50 minus 47. So you'd only lose $3 in this case, but you need the price to drop all the way below 22.5. Where if you were buying out of the money and you think the price is going to stay about where it's at or just drop a little bit, you have a lot better odds of making money. Now let's go back to put credit spreads, and I'll explain how this is a pretty ideal option strategy for beginners. So not only are you risking a small amount of money, you also don't get a lot of profit, but you're not risking your entire account or an entire contract for a put or a call. So like we explained earlier, you're making this $12, but you're putting up 50 as collateral, so your max loss is 38 and your max gain is $12. But you also make money as theta kicks in, because theta, remember, is time decay. And as you get closer to expiration, the spread between these two is going to get closer. And when the spread gets closer, you're making more money. So I can show you an example here. If we go out, say, to August 14th, you can see the difference here is $19. Between 81 and 62, you would sell this one and buy this one. And the one we were looking at, the difference was $12. So just by holding, if the price were to stay the same and you were to hold this credit spread, you would make that difference between August 14th and July 24th. So you'd make 19 minus 12, which is $7, just by holding it. And there's a lot of cases where you make a decent bit more than just $9 if you were to hold it for 3 weeks. Like here, if we were to look at July 31st, it's almost the same spread because time decay is exponential. It gets bigger as it gets closer to expiration. So here we're looking at July 31st and the spread is $18. But when we go to July 24th, it's $12. So rather than having to wait that entire time, that extra 2 weeks, this only has a $1 less spread because the exponential curve hasn't set in yet. But once it sets in, if you were 1 or 2 days away from expiration, that theta is going to really kick in and you're going to be making money even if the price stays the same. So that's kind of why it's ideal for beginners, because you almost don't have to do anything. As time progresses, you make more money. So if you wanted to make money with not much risk, you could just choose an expiration date that's really far out, say November 20th, and then you choose a price that you think is very unrealistic that the price will hit. So to recap, the main things that you want to pay attention to are the profit and the loss, which your potential loss is the difference between the strike prices minus your premium that you collect. So here again, $50 is the collateral, and the premium you collect is $12, so you're risking $38 in this situation when you have a credit spread, and then your potential gain is $12. And you should also keep in mind that you want the price to move the opposite of what the normal option is. So when you have a credit spread for puts, you want the price to go up, and when you have a credit spread for calls, you want the price to go down. And remember to calculate your profit at any time. You just take the premium you collected, so here it's $12, and then you subtract the new difference between the contracts. So here it'd be $1. You would profit $12 minus $1, which is $11. But Robinhood will tell you what your return is, so you shouldn't really have to do any calculating, but it's a good thing to know how to do. And the last thing to keep in mind is that this is great for beginners because you also make money as time decay wears on the price of the contracts. So you can kind of sit back and just relax and make money as long as the price doesn't drop below your strike price, at least for puts. And for calls, you wouldn't want, if you were to buy this credit spread here, you wouldn't want the price to go above. So as long as time progresses, you're making money because the spreads get closer and closer as it gets closer to expiration. So I hope this helped anybody out there who's trying to get into options trading but doesn't have a large account or a large capital to invest in companies and buy the full premium price. You can see that you can get started with as little as the collateral between these, minus the premium you collect. So when we were looking at this put credit spread, you could get started with as little as $38. You could have $38 in your account and you could buy this credit spread. And then if you were to win, you'd make $12. And then you just keep doing it and you keep growing your account. Obviously, this is kind of my opinion, and I think for a beginner, this is the simplest way and the cheapest way to get into options. There's obviously other strategies you can do, like debit spreads, and there's iron condors and butterfly spreads, and I can make videos about all those strategies as well, which small accounts can also benefit from. But I think credit spreads are the most ideal because most of the time you're making money still as time progresses. It's not guaranteed, obviously, if the price were to drop below your strike price, but as long as the share price stays where it is or goes up, you're making money, and you could get out of that credit spread at any time and secure your profit. And for those who stayed this far into the video, now I'll be buying a credit spread to show you exactly how it works. And I'll be selling one as well to show you how to get out of the credit spread if you wanted to secure profits or get out early. So as you can see, I'm going to place a credit spread on QQQ because they generally have an upwards trend. So I'm going to buy a put credit spread. And I did plan on trading this live, but the audio had cut out when I was recording. So I'm voicing over the trade that I did. So because QQQ has a general upwards trend, I decided to place a put credit spread. And they did kind of tank today. They went from 264 all the way down to 258. And you can see I had previous credit spread that I was planning on selling live to show you guys how it works. But the price kind of tanked, and now I'm not sure whether they're going to be profitable, so I'm going to hold them until tomorrow. But anyway, I decided to buy a credit spread that was a bit lower, something I thought would be a bit more unrealistic that QQQ would hit. So I bought the 252 strike at $35, and I sold the 252.5 strike at $40. Essentially netting $5 profit if QQQ stays above 252.50 at expiration, which is tomorrow. You can also see once you sell one strike and buy the other, it'll tell you exactly what kind of spread you're doing. So in this case, it's a put credit spread, which means we want the price to stay above our top strike price of 252.5. So once you have everything set up and it says that you're doing a credit spread, you just click continue, and then you put in how many contracts you want, which would times everything by how many contracts you have. So if you bought 2 contracts, for example, instead of a $6 credit, which is the difference between the 2 premiums, you would get $12 instead, but you'd be putting up $100 instead of just $50 as collateral. So once you put in that you want 1 contract, which is what I'm doing here, I also put in the limit price, which is taking into account the bid and the ask for both options, both the one I'm selling and buying. So that's why there's a difference from 2 cents all the way up to 9 cents. And whatever you put in, that's the credit you're going to receive. But the higher you go, the less likely it is to get filled. So I just stuck with what it was as default, which is 6 cents, which will give me a credit of $6. And you know you're doing it right if it says minimum credit. If it says cost, then you're doing a debit spread, which is for a whole nother video. And it looks like I changed it here to 5 cents to get filled quicker, just for the video. So I'm not netting $6, I'm netting $5. And then you click review order. And then as you can see, you're putting up a $50 collateral for the chance to make $5 if the price stays above 252.5. And you can see you're buying to open the 252 and you're selling to open the 252.5. And then you just click submit and you wait to get filled. And you can see it's pending now, and it got filled right away because I changed it to 5 instead of 6. If I would have kept it at $6, it probably would have taken a little bit longer to get filled. And you can see now my available balance is only $7, where before it was $52.60 something cents. When I was first selling credit spreads, I was a little confused as to how that worked. But because you're receiving a $5 credit in this situation, and they're taking 50 as collateral, they take the 50, which would bring my available balance down to $2. And then because I'm getting $5 in credit back, which I keep no matter what, that brings it up to $7. And so if the price stayed above that 252.5 at expiration, I would get the full $50 collateral back. So that's how you would net the $5. I mean, you already have the $5 credit, but that's how you get your full collateral back, which sort of is how you gain that profit. So now after you've placed your trade, you just go back to your home screen and then you click on the credit spread that you want to close. So for me, it's the 252.5 and the 252. And then you type in however many contracts that you want to close. And I only have one, so I'm typing in 1. And then you type in the limit price that you want to buy it back for. So whatever you sold it for minus what you buy it back for is your profit. So I originally placed the credit spread at $5. And now I'm trying to buy it back at $3, which would net me a $2 profit. But you can see, obviously, it's trading at around $6 to $7. So this won't get filled, obviously, but it's just for demonstration purposes. So you can see exactly how to close a contract. And you want to make sure you're on close and not open. When you're closing, it should say max cost because you have to buy back the contract to close it. So then you click review order and you can see you're buying to close the 252.5 and you're selling to close the 252, which is the opposite of what you did originally to open the contract. And then you just click submit and you wait for it to get filled. Now this isn't going to get filled because the price is higher than this right now. And you also need it to say filled. Right now it says credit spread placed because I know that's a little confusing for people at first too. It has to say filled in order for it to be executed. So now I'm just canceling this order because it's not going to go through. And I'll just hold it until tomorrow and then I'll gain that $5 profit as long as the price stays above 252.5. So I think that about wraps up credit spreads and kind of gives you a general idea of how they work. There's a lot more to them, but this kind of gives you a good basic idea and understanding of how they work. So if you learned anything, make sure you hit the like button and subscribe if you're new and hit the notification bell so you never miss when I upload more videos like this. Also, don't forget to sign up for Webull and Robinhood. Links are in the description down below. When you sign up for Webull, you'll get 2 free stocks, one when you sign up and one when you deposit $100. When you sign up for Robinhood, you'll get a free stock and you don't even need to deposit anything. But with that said, thank you so much for watching and I'll see you back here in the next one. Bye.